liquidity, leverage, and low commissions, this has to be the best product to trade. That's exactly why we're going to explore the E-mini contracts, S&P, Nasdaq, and Dow Jones futures. All information in this video is for educational purposes only. It's not an offer recommendation to trade futures, stocks, options, or Forex. E-mini contracts. This is exactly off of the CME website, the Chicago Mercantile Exchange, who runs not all futures contracts, but they do run the E-mini contracts. Some of the commodities are through other exchanges, but the simple way that they like to define this is capitalize on the round-the-clock liquidity of E-mini S&P futures. You could replace that with Nasdaq futures, Dow futures, Russell futures. Take advantage of one of the most efficient and cost-effective ways to gain market exposure to the S&P 500 index. That's important. It is and I totally agree with this, it is the most efficient and cost-effective way to gain market exposure to S&P 500. Talks a little about the S&P 500. All the indexes are replicas of the ETFs, being the S&P, the Nasdaq, and the Dow. Lots of companies included in each, and each of them have a futures contract. Some features of the E-mini futures contracts. Some of the best things, maybe reasons why they are superior products to what I think ETFs or options. Well, I love futures. Liquidity. Tight bid-ask spreads can reduce the cost of trades. The bid-ask spread would be what someone is offering to buy and what a dealer, a person, a market maker, is selling it at. Most of these products, the S&P, the Nasdaq, and Dow, they all pretty much have a quarter point spread, which is as small as it could possibly be. They are all very liquid products. They are safe. They're secure. Central clearing via the CME, who I mentioned earlier. It gets rid of counterparty risk you may experience using CFDs. I know out there's some CFD products, which are levered products, but they are not ran through the CME. They ran through all sorts of other kind of random brokers. And the CME is a very reputable, safe way to get exposure to these levered products. Leverage. What is leverage? It's playing with more money than you put down is the simple way. With up to 50 to 1 leverage on a full, that would be the S&P E-mini. The ES contract would be 50 to 1. And then as we'll say as little, it's still 100% leverage. The micro Nasdaq is 2 to 1. It's obviously a big range of leverage. There's all sorts of, there's a micro and a regular contract for each of the indices. And so you can trade very large value with a small amount of upfront capital. We'll get into margin requirements, but you can, depending on your broker, I've opened a S&P E-mini contract, which is over $200,000 of exposure. You just times the, S&P's floating around 4,800, times that by 50. We're looking at $240,000 of exposure, and some brokers get as low as $400 for margin requirement. You would need a little cushion there, but ultimately the point is you can get significant exposure for a insignificant amount of money relative to what you're getting. And for that, there are commissions, but they're very low commissions. Commissions do fluctuate between brokers, but again, the cost of the contract relative to the value of the contract is extremely low. You can open the micro contracts for, again, depending on the broker, anywhere you can get down to 50 cents for getting long, and then another 50 cents to close it. There's 2 transactions when you trade: the opening commission to open the price, and then also to close it, you're going to pay another commission. And then the full contracts can flow around for round trip opening and closing. You can get around $4, give or take. So again, not a lot of money up front for how much you're getting exposure to. Not a big fee. So these are, again, I think, superior products. Another good feature is the ability to short and hedge. Futures are the most efficient way to get short the market with less variables than options. They're both derivative products based off of the underlying ETFs, but options have the Greeks and time decay and a lot more stuff where you really need to know what you're doing. And futures, you see the price you're opening at, and it's just going to move with the market. So it's much more simple for directional trades. You heard me mention margin requirements, so let's get into what exactly that is. Margin requirement is the amount of money that must be deposited and maintained by an investor with their broker when they open a position in a futures contract. So there's two types of margin. Your initial margin, that's the initial deposit required to open a position. It's percentage of the total contract value. It's set by the exchange on which the contract is traded. This requirement is meant to ensure there's enough capital to cover potential losses. This can range a good bit. Again, I've opened with a like day trading initial margin with a broker. I opened an E-mini contract, and the initial margin was $400. Pretty small. And some longer term accounts that I've had at TD Ameritrade, like in my IRA or cash account that I don't necessarily day trade, it's up to $12,000 for an E-mini S&P. Again, it's obviously a big difference there, but still $12,000-ish. It floats around there. I forget if it was the S&P or the Nasdaq, but we'll say $12,000. But you're still, again, we're getting $240,000 of exposure. So you don't have to put in near as much in your account and then let it have a lot of exposure. Now you have your maintenance margin after the position is opened. So you already have your initial margin. You open the position. Now you have maintenance margin. The investor must maintain a certain level of capital in their account, known as the maintenance margin. If the balance if it falls below this level, you'll get a margin call. The margin call will say, hello, your account is under X amount because of this position. You either need to add money or we're going to liquidate the position. So the maintenance margin will be above the initial margin to give the broker room. It's just simple risk management for them, so they can't lose more than you have there. So there's no, you ultimately are responsible for the amount that the futures contract will move, and if it gets below what's safe for the broker, they will just close your position in a margin call. Futures rollover. This is an interesting thing that people may not know about. The contract roll. It's the process of closing a position in a futures contract that is nearing its expiration date and opening a new position in a contract with a later expiration date. A majority of trades take place on the front month contract, but traders will roll their contracts when the next month is near. It typically happens over a week. So, like it says on the bottom, the contracts roll months are March, June, September, and December. So those will all be at different prices because typically the market is expected to be higher in the future. So if March is at, here, I'm just going to look it up right now. If March is at 48, what's it at? ES, have it on a different screen. ES1 is 48.14 and ES2 is 48.68, right? So it's about 1% different because over time the market is expected to go up. So the people who are getting into these further contracts are expecting for the contract to be further out. And so the roll takes place on the third Friday of each month. One thing I will note about futures rollover, So if you're in the third Friday in March and it's rollover week, the liquidity will begin to change over to the next contract. And once 80% of the liquidity is in the June contract, but it's still March, it's before the third Friday, say it's the second Friday, so you got a week. The March contract liquidity, the spreads may start to slightly widen more because the liquidity is left. It's moved on. Trading can often be a little strange during that week until a majority of the people, of traders, all basically agree and move on to the next contract. So again, futures are an incredible product. So let's get into contract specifications, the specs. Got these three. The S&P, this is the most liquid, most traded, most volume contract. And like I said earlier, it is 50x the S&P index. Tick size, it's in 0.25 index points. So the index is SPX, not the SPY. So SPX will actually be 4,812, whatever I just said. SPY would be 400 and something, where this is based off of the SPX. So 4,113 and then 4,113.25 up to 4,113.5. It moves like that. And each tick is 1250. So 1 point, if it went from 4,813 to 4,814, that'd be 4 ticks because it's 4.25 for a whole point. And that would be $50. That's why it's 50x the S&P. And Nasdaq, same thought behind it. It moves in the 0.25s, and it's 20x. So it's $5 for each one of these. So for each point of NDX, not the Qs, NDX, they're very similar products but priced differently, is $5 per 0.25 and $20 per 1 point. So that is 20 to 1 leverage, 50 to 1 leverage, 50 to 1 leverage. The Dow, it's a lot higher. It's in the 30,000s, I believe. It is so it moves in ones. It's so many thousand, it's so much bigger than both of these that it doesn't even move in 0.25s. It actually just moves in 1 point, and each point is $5. So there is that's still a lot of leverage. Thought this was interesting. And this, I don't have paid current data from this website, but I was just looking for the growth of futures and derivatives. You can see since 2012 to 22, futures actually tripled in volume. Futures and options, so derivatives. They're pretty equal on the volume that is played, but options are often used by market makers and dealers, and so are futures. So they're split about half on what the total volume is here, but you can see the growth of both of these derivative products. So again, there's tons of upside. There's a lot of reasons to trade futures. Again, I think it's the third or fourth time I said it. I do find it to be a superior product than ETF. It lets you not use a lot of capital to get a lot of exposure, and then you can use your money elsewhere, whether keeping it in cash or putting it in non-correlated investments. There's a whole bunch of different ideas what you can do, but futures are ultimately incredible for many of reasons, and I hope you learned something on this talk about futures.